Numbrinke Bagerbius 1 Linka, Gap Chordina Hook, Suspense R part, 1:9:38 p.m. Silver's worst day in 45 years, minus 31%. Crash explained. Gore down 850. 72 hours. That's all it took to erase $10 trillion from the precious metals market. January 30th, 2026. Gold touched $5,600 per ounce. Silver reached $120. Then, something broke. By Monday morning, silver had suffered its worst single-day collapse since March 1980. But here's what they're not telling you. While paper prices were crashing 31%, physical silver in Shanghai was trading at 12% premium. In Japan, 60% premium. Dubai, 40% above spot. The COMEX vaults drained 60% of their inventory in 4 days. So which price is real? And why are the world's largest banks still calling for $100 silver after the worst crash in 45 years? What happened last week wasn't just a correction, it was a warning. Welcome to AO and AG, where we analyze the markets others overlook. If you value clarity over noise, substance over speculation, then you're in the right place. May I ask you something? Where are you watching this from today? Are you in North America, Europe, Asia, the Middle East? Drop your location in the comments below. I'm genuinely curious to know where serious minds like yours are tuning in from. And if you find value in this kind of no-nonsense economic analysis, the kind they don't show you on mainstream financial television, then consider subscribing to this channel. Think of it as joining a network of informed individuals who understand that markets don't just move randomly, they speak, if you know how to listen. Hit that subscribe button, not because I'm asking for a favor, but because the next market signal could be the one that saves or makes your portfolio. Now, let's examine what really happened last week. The date was January 30th, 2026. Precious metals traders around the world were celebrating. Gold had just touched an all-time high of $5,600 per ounce. Silver was trading at $120. Online forums were filled with predictions. $10,000 gold, $200 silver. Euphoria had reached its peak. No one saw what was coming. Within 72 hours, the precious metals market would experience its most violent collapse in 45 years. The kind of event that traders study in textbooks. The kind that changes market structure forever. The kind that separates those who understand risk from those who merely chase returns. Friday, January 31st, 2026, will be remembered as the day silver died, at least temporarily. When trading opened that morning, something was different. The usual buying pressure wasn't there. Instead, selling. Heavy, relentless selling. By midday, traders were staring at their screens in disbelief. Silver futures were in free fall. By the closing bell, silver had plummeted 31.4% to settle at $78.53 per ounce. A single-day loss of over $41, the worst performance since March 1980, when the Hunt brothers' attempt to corner the silver market collapsed spectacularly. But silver wasn't alone in its descent. Gold, the supposed safe haven, the asset that had reached historic highs just 24 hours earlier, lost $850 in a single trading session. Nearly 10% of its value gone. The metal that central banks hoard, that governments stockpile, that investors flee to during crisis, was being dumped like a liability. By Monday morning, February 2nd, the carnage continued. Gold futures slid another 3% to around $4,707 before finding temporary support. Silver ticked down slightly to 70, as if catching its breath after the Friday massacre. The numbers alone don't capture the magnitude of what occurred. Over $10 trillion in combined market value had evaporated. Not over months, not over weeks, but over 3 days. Pension funds, sovereign wealth funds, institutional investors, retail traders, all watched their positions collapse in real time. This wasn't normal market behavior. Experienced traders know volatility. They understand corrections. A 5% move, common. A 10% correction, painful but expected. But a 31% single-day crash in a major commodity market, that doesn't happen without something breaking. The question wasn't just what happened, but why it happened with such extreme violence. Market observers immediately began searching for explanations. Some pointed to profit-taking after the extraordinary rally. Others blamed technical factors, key support levels breaking, stop losses triggering in cascade. The financial media quickly assembled their usual narratives about overheated markets and necessary corrections. But those who understood market mechanics, who had seen leverage blow up before, who recognized the patterns of forced liquidation, they knew this was something different. This was a liquidation event, the kind that happens when too many market participants are positioned the same way, using too much borrowed money, betting that prices only go up. When markets are structured this way, all it takes is one trigger. one catalyst, and the entire edifice collapses on itself. The trigger came from an unexpected source, not from the commodity markets themselves, not from a supply shock or demand collapse, not from a geopolitical crisis or natural disaster. The trigger came from Washington, D.C., from a single political appointment that would reshape monetary policy expectations overnight. President Donald Trump had nominated Kevin Warsh as the next chair of the Federal Reserve. To casual observers, this seemed like routine political news. Another appointment, another bureaucrat, another Washington story that would fade from headlines in days. But to those who understood monetary policy, who knew Warsh's reputation, who recognized what this signaled about future interest rates, this was a seismic shift. Kevin Warsh had built his reputation as a monetary hawk, someone who believed in higher interest rates to control inflation, someone who advocated for tighter policy when others called for accommodation, someone whose appointment meant the era of easy money, the environment that had pushed gold and silver to record highs, might be ending. When Warsh's nomination leaked Thursday afternoon, the reaction was immediate. The U.S. dollar index strengthened, Treasury yields began climbing, and precious metals began their death spiral. The mechanism was straightforward. Higher interest rates make bonds more attractive. A stronger dollar makes gold more expensive for foreign buyers. Non-yielding assets like precious metals suddenly face real competition from interest-bearing alternatives. But this explanation, while accurate, only scratched the surface of what was really happening, because while prices were crashing on paper, something very strange was happening in the physical market. The Warsh nomination was the match, but the House was already soaked in gasoline. What unfolded between January 30th and February 2nd wasn't simply a reaction to political news. It was the unwinding of one of the largest leveraged bets in commodity market history. A bet that had been building quietly, systematically, dangerously, for months. To understand what really happened, one must first understand how modern precious metals markets actually work. Most people believe that when they see gold trading at $500-600 per ounce, they're watching the price of physical metal. They imagine vaults, bars stacked in rows, tangible wealth-changing hands. The reality is far different. For every ounce of physical gold or silver that exists, there are approximately 100 paper claims on that same ounce. Futures contracts, options, exchange-traded funds, derivatives built on derivatives, a massive pyramid of paper promises, all resting on a relatively small foundation of actual metal. This system works perfectly until it doesn't. January 2026 represented the doesn't scenario. In the weeks leading up to the crash, speculative positioning in precious metals had reached historic extremes. Hedge funds, commodity trading advisors, even retail investors using margin accounts, all were positioned heavily long. Betting that prices would continue rising, they were using leverage. Leverage is Wall Street's favorite drug. It allows traders to control $100,000 worth of metal with only $6,000 of actual capital. When prices rise 10%, the leverage trader makes 166% on their capital. It's intoxicating. It creates millionaires overnight. It also creates catastrophic losses with equal speed. When Warsh's nomination hit the wires Thursday afternoon, prices began falling. Not dramatically at first, just a few percentage points. Uncomfortable, but manageable. Then Friday's Asian session opened. Margin calls began hitting accounts across the globe. A margin call is Wall Street's polite way of saying, "You're losing money. Send us more cash immediately, or we'll close your position whether you like it or not." Thousands of traders woke up to these demands. They had two choices: deposit more capital to maintain their positions, or accept forced liquidation. Most couldn't deposit more capital. The selling began in earnest. As positions were forcibly closed, prices fell further. As prices fell further, more margin calls triggered. More forced selling, lower prices, more margin calls. A vicious cycle feeding on itself. A cascade with no natural stopping point except complete capitulation. By Friday afternoon, the Chicago Mercantile Exchange had seen enough. The CME Group, which operates the COMEX Precious Metals Exchange, made an emergency decision. They increased margin requirements across the board. Gold margins rose from 6% to 8%. Silver margins jumped from 11% to 15%. On the surface, this looked like prudent risk management. Protect the clearinghouse, ensure market stability. In practice, it was like throwing gasoline on a fire. Every trader holding leveraged positions suddenly needed to post significantly more collateral. Immediately. Not tomorrow, not next week, now. Those who couldn't were liquidated. The Friday massacre wasn't about fundamentals. It wasn't about supply and demand for physical metal. It wasn't even primarily about the Warsh nomination anymore. It was about a system-wide deleveraging event. Institutional desks were calling clients, demanding additional margin. Brokers were liquidating accounts wholesale. Automated trading systems were hitting pre-programmed stop-loss levels, triggering more selling. High-frequency trading algorithms detected the momentum and piled on. selling into the decline to capture micro profits from the volatility. The market had become a machine, feeding on itself. But here's what made this event truly unprecedented. While this liquidation storm raged through the paper markets, while futures contracts were being dumped at any price, while ETFs saw massive outflows, something completely contradictory was happening in the physical world. People were buying, not just retail investors looking for bargains, not just gold bugs with "I told you so" syndrome. Institutional buyers, industrial users, central banks, sovereign wealth funds. They were buying actual metal, the kind you can touch, the kind that requires armored trucks and vault storage, the kind that can't be created with a keystroke or printed on a futures exchange. And they weren't just buying at market prices. They were paying premiums, significant premiums. In Shanghai, physical silver was trading 12% to 13% above the official COMEX price. Think about that. While paper silver was crashing to $78 per ounce, Chinese buyers were paying $88 to $90 for actual metal. In Japan, the premium reached 60% on secondary markets. In Dubai, 40% above spot. This created a bizarre situation that shouldn't exist in efficient markets. Two prices for the same commodity: the paper price and the real price, the theoretical price and the actual cost of acquiring physical metal. This divergence has a name in commodity markets: backwardation. Backwardation occurs when immediate delivery of a commodity costs more than future delivery. It's the market screaming, "We need this metal now, and we're not confident it will be available later." Normal market structure shows the opposite. Future delivery should cost more due to storage, insurance, and carry costs. This is called contango. It's how commodity markets are supposed to work. When markets flip into backwardation, especially deep, sustained backwardation, it signals fundamental supply stress. It means the system is breaking. And that's exactly what the physical markets were signaling while paper prices collapsed. December 2025. While the world was preparing for holidays, something extraordinary was happening inside the COMEX warehouses in New York. Metal was disappearing. Not through theft, not through accounting errors, through delivery demands. Actual buyers were standing for delivery, demanding physical metal, draining the registered inventory at a pace the exchange had never witnessed. In just 4 trading days, 47.6 million ounces of silver vanished from COMEX registered vaults. That represented 60% of available delivery inventory. Gone. To understand the significance, one must understand how the COMEX system operates. The exchange maintains 2 categories of metal: registered and eligible. Registered metal is available for immediate delivery against futures contracts. Eligible metal is stored in COMEX-approved vaults, but not available for delivery unless the owner designates it as registered. Think of registered inventory as metal actively for sale. Eligible inventory as metal sitting in the warehouse, but not on the market. For decades, this 2-tier system worked smoothly. Most futures contracts were settled in cash, not metal. Traders bought and sold paper contracts, made or lost money, and never actually took delivery of physical silver. The registered inventory was merely a backstop, a guarantee that physical settlement was possible if needed. December 2025 shattered that equilibrium. Suddenly, everyone wanted actual metal. Not cash settlement, not paper promises, real silver they could hold, store, and control. The registered inventory plummeted from roughly 79 million ounces to less than 32 million ounces in 4 days. The fastest drawdown in COMEX history. This wasn't random. This was coordinated. Sophisticated buyers who understood that paper claims might not be worth the contracts they were printed on. But the December drain was merely a prologue. From September 2025 through February 2026, COMEX registered silver inventory had been bleeding steadily. Month after month, more metal left than entered. The exchange was becoming a one-way door. Metal flowing out to buyers demanding delivery with minimal replenishment. By the time the January crash occurred, COMEX vaults were already under severe stress. Then came the truly alarming data point: Shanghai. The Shanghai Gold Exchange operates differently from Western markets. It's a physical settlement exchange. When you buy metal on the SGE, you get metal. No cash settlement option, no paper games. Real transactions for real metal. And Shanghai prices had completely decoupled from London and New York. Physical silver on the SGE was trading at 12% to 13% premium over COMEX futures and LBMA spot prices. This wasn't a temporary arbitrage opportunity. This was sustained divergence that had persisted for weeks. In efficient markets, such price differences shouldn't exist. Arbitrageurs should immediately buy cheap in New York, sell expensive in Shanghai, and pocket the difference. This arbitrage activity would equalize prices within hours. It wasn't happening. Why? Because moving physical metal from west to east had become difficult, expensive, and increasingly restricted. China had made a strategic decision that would reshape global silver markets permanently. In 2026, the Chinese government reclassified silver as a strategic material. This wasn't merely bureaucratic reshuffling, it was economic warfare disguised as policy. Strategic material designation meant export restrictions. China produces approximately 15% of global silver supply. When the world's second largest producer restricts exports, supply chains break. Western buyers could no longer easily access Chinese silver. Chinese buyers could purchase Western silver, but why would they when domestic supply was now captive? The global silver market had fragmented. One price in the East, another price in the West, and the gap was widening. Japan told an even more extreme story. On secondary market platforms like Mercari, physical silver premiums had spiked to 60% above spot prices. Japanese buyers were paying $125 per ounce for metal that officially traded at $78, 60% premium. This wasn't irrational exuberance. Japanese investors remembered their history. They understood currency debasement. They had lived through decades of failed monetary experiments. When they saw Western paper prices crashing, while physical supply tightened, they drew obvious conclusions. Paper is paper. Metal is metal. They chose metal. Dubai presented similar dynamics. As a major physical trading hub connecting East and West, Dubai premiums reflected real-world supply constraints. 40% premiums weren't speculation. They were the actual cost of securing physical silver in a market where registered inventory was evaporating. Meanwhile, Western financial media continued reporting the COMEX price as if it represented reality. $78 per ounce, they said. Silver has crashed. The bull market is over. Only in derivative markets. Only in the paper realm. Real metal, deliverable metal, metal you could touch and store, commanded massive premiums. This created a philosophical question with profound implications. Which price is real? Is the real price the one on COMEX, where contracts are traded but rarely delivered? Or is the real price the one in Shanghai, Dubai, and Tokyo, where actual metal changes hands? The answer reveals everything about what was really happening. Industrial users provided additional confirmation. Companies that manufacture solar panels, electronics, medical equipment were increasingly bypassing COMEX entirely. They were going directly to refineries, paying premiums and securing long-term supply contracts. Why? Because they understood something crucial. Silver isn't optional for their products. You cannot manufacture a solar panel without silver. You cannot build certain medical devices without silver. You cannot produce specific electronics without silver. No substitute exists for many applications. When industrial users are willing to pay 40% premiums over spot prices, they're sending a signal. We need actual metal, and we'll pay whatever necessary to secure supply. This behavior doesn't emerge during normal corrections. This is crisis behavior. Bank of America's research division had been tracking these dynamics closely. Their analysts published a remarkable forecast in late January, just before the crash. They projected silver reaching $65 per ounce in 2026, with an average price of $56.25. Their reasoning was straightforward. Persistent supply deficits and irreversible industrial demand. The crash didn't change their analysis. After prices plummeted, BofA maintained their forecast. Because the fundamentals hadn't changed, the paper price had changed. But the physical supply-demand imbalance remained. They understood what many didn't. The crash was in derivatives, not in reality. The crash had happened. The dust was settling. Now came the trillion-dollar question. What happens next? In the days following the February 2nd collapse, analysts at the world's largest financial institutions were burning midnight oil. Trading desks were recalibrating models. Risk managers were stress-testing portfolios. And senior strategists were making calls that would define their careers. The consensus emerging from these closed-door meetings was unexpected. Despite witnessing the worst precious metals crash in 45 years, the major banks weren't turning bearish, they were doubling down. Citigroup published their revised precious metals outlook on February 4th. Their target? Silver reaching $100 per ounce by March 2026. Not by year-end, not eventually, within weeks. Their bull case extended further. Potential upside to 110 per ounce in the second half of 2026 if supply constraints intensified. Think about what this meant. Silver had just crashed from $120 to $78, a 35% collapse. And Citigroup was forecasting it would not only recover, but exceed previous highs within months. This wasn't hopium. This was institutional capital making directional bets. UBS followed with their gold forecast. Their base case projected gold trading between $4,800 and $5,000 per ounce by December 2026. Currently trading at $4,700, this represented modest upside, but crucially, it assumed no further collapse. UBS wasn't forecasting disaster. They were forecasting stabilization and recovery. Goldman Sachs remained conspicuously bullish on the debasement trade. The thesis that rising government debt and currency devaluation would drive investors toward hard assets. The crash, in their view, changed nothing about fiscal trajectories or monetary incentives. Even Bank of America, known for conservative forecasts, maintained their $65 silver target with $56.25 average. They explicitly stated that the crash reflects temporary dislocation rather than fundamental deterioration. Independent analysts went further. Andrew Maguire, a veteran precious metals trader, was calling for $8,000 gold. His reasoning centered on the paper physical disconnect becoming untenable. Either paper prices rise to match physical replacement costs, or the derivative markets lose credibility entirely. Multiple analysts were targeting $150 to $170 silver if the physical squeeze continued. These weren't fringe voices. These were professionals risking reputation and capital on specific price targets. But forecasts mean nothing without framework. The question wasn't whether silver could reach $100, but under what conditions it would happen. Three distinct scenarios emerged from institutional analysis. Scenario 1, the deflationary collapse probability, 30% timeline, 1 to 3 months. In this scenario, the crash was only beginning. Gold would test $4,000, silver would fall to $65, $70. Physical premiums would compress as liquidity needs overwhelmed positioning preferences. This outcome required specific conditions: a major economic crisis, forced selling from ETFs and institutional holders needing to raise cash, sustained dollar strength as global capital fled to U.S. assets, Federal Reserve commitment to hawkish policy regardless of market pain. Essentially, this was the 2008 playbook. When Lehman Brothers collapsed, gold initially fell as hedge funds sold everything liquid to meet margin calls. Only later did it rally to new highs. If a similar credit crisis emerged, if banks faced solvency questions, if margin calls hit across all asset classes simultaneously, precious metals would sell off despite being safe havens. The irony of safe havens is that they're often sold first during forced liquidation, not because they're unsafe, but because they're liquid. This scenario also required the paper physical disconnect to resolve through physical prices falling, not paper prices rising. It meant the Shanghai premiums were temporary. The COMEX drain would reverse. Industrial buyers would reduce purchases. Possible? Yes. Likely? Less certain. Scenario 2, range-bound consolidation. Probability, 40%. Timeline, 2 to 4 months. This was the consensus institutional view. Prices would stabilize within current ranges. Gold between $4,500 and $5,000, silver between $75 and $90. Physical premiums would remain elevated but stop expanding. The panic selling would end, but structural tensions would remain unresolved. Neither paper market breakdown nor complete recovery. This scenario reflected market exhaustion. The leveraged positions had been flushed out. The weak hands had been shaken. What remained were holders with conviction and capital. Volume would decrease. Volatility would compress. The market would enter digestion phase, processing what happened, waiting for the next catalyst. This wasn't bullish or bearish. It was simply waiting. For this scenario to play out, several conditions were necessary. Bitcoin stabilizing above $80,000 as a risk appetite indicator. Gold holding $4,500 support for at least 3 consecutive days. CME margin requirements remaining stable. No major economic surprises in either direction. Most institutional trading desks asked positioned for this scenario, not because it was exciting, but because it was most probable. Markets spend far more time consolidating than trending. Scenario 3, the bullish resolution probability, 30% on timeline, 3 to 6 months. In this outcome, prices didn't just recover, they exploded. This required the paper physical disconnect to resolve in favor of physical reality. It meant Shanghai premiums weren't temporary aberrations, but accurate signals. It meant COMEX either defaulted on deliveries or prices adjusted to physical replacement costs. Specific catalysts would trigger this path. Continued central bank accumulation, regardless of price. Industrial demand remaining strong, despite economic uncertainty. Federal Reserve policy pivot back toward accommodation. And critically, a delivery failure at COMEX or LBMA that shattered confidence in paper claims. This was the scenario that kept risk managers awake at night. Because if it occurred, it wouldn't be gradual. It would be violent. A short squeeze magnified by industrial panic buying. Prices gapping higher by hundreds of dollars overnight as buyers competed for limited supply. Independent analyst forecasts of 150 plus silver weren't predicting normal market behavior. They were predicting market structure failure, the kind where normal price discovery breaks down entirely. Each scenario required monitoring specific indicators. For the bear case, watch physical premiums. If Shanghai premiums compressed below 5%, it signaled genuine demand weakness. If COMEX vaults saw major inflows of registered metal, it contradicted the shortage narrative. For consolidation, watch Bitcoin. If it held above $80,000, risk appetite remained intact. Watch gold's $4,500 support level. 3 days of holding suggested stability. For the bull case, watch for delivery failures. Watch for further vault drains. Watch for premiums expanding beyond current levels. One indicator trumped all others: China's behavior. If Chinese reserves were dumped into the market, it signaled something worse was coming. If Chinese buying accelerated despite high prices, it confirmed strategic accumulation regardless of cost. As February progressed, the market remained suspended between these three paths, waiting for the catalyst that would determine which future would unfold.